All right, good afternoon, everyone. Sorry I'm running late here. They already dropped those minutes, as we can tell from the extreme volatility. I was just in the middle of teaching the workshop, and everybody's asking all these questions. What about the poor high? What about the poor low? What about this week reference? And I laughed and I said, don't worry, they will all be taken out in a fraction of a minute once those notes come out. And the first thing we did was we just cleaned up all that weakness below. So what are we expecting now? Well, we don't know what to expect now, but we know the volatility is going to be extreme for the next probably 15 minutes or so. The market's going to go up and down extremely fast and be very difficult to read. Generally speaking, whatever direction it makes, if it makes a directional move in these first 15 minutes or so, let's say it were to shoot much lower or it were to shoot much higher, it will almost always retrace that move at some point. So don't necessarily focus on the first move the market makes, but rather when it gets overextended and starts to come back. The volatility will last about 15-20 minutes, then it'll slow right down at about 220. And once it slows down, the market goes nowhere until 2:30 when Chairman Powell comes out to speak. Once he comes out, then the real party starts. Ba-da-ba-ba-da-ba-da-ba. So I will play the video of that and we will listen to it together while we watch the market bounce around like crazy and try to make some predictions as where it's going to go next. As I've said many times before to the brigade members that regularly follow my channel, trading the FOMC is gambling. There is no way to have any kind of statistical edge here. So if you're entering a trade, you must accept that you don't really know what's coming next and that it could reverse on you and move very far, very fast. So these are fun markets to trade because if you're right, you can make a lot of money very quick. But they are also painful markets to trade because if you're wrong, you can lose it just as fast. We got 49 people hanging out. Please smash that thumbs up button so we can let all our other friends know that we're here. Good afternoon, Pavel. Scooball. Frito says, time to roll the dice. Yeah, baby. Welcome to the casino. Red or black, put your money down. Tim says, happy Fed decision thingy. Happy Fed decision thingy. Hello to Gino. Sherm, welcome. Nap is here. Like it up. Let's get them likes. I've also heard, I'm not stating this like it's a fact, but I have heard that people that push the like button make way more money. It's like it's good luck. So I'm just going to put it out there. And you could do with that information what you will. Fighter Pilot says, I hope your workshop is going great. Nice rotations in the lower distribution from yesterday. Yeah, I mean, bigger picture, we're just literally smack dab in the middle of a balance area. So the way I read it, this is the balance area high. This is the balance area low, and we are just stuck in the middle. What's nice about being stuck in the middle, if they break out one way or another today, it could lead to some momentum. So if we're able to head up, once the FOMC is done, we're able to stay above that balance area high. That could lead to further upside continuation tomorrow, which would be very probable trades. Same thing if we break the low. We could start to sell off back to fill that old gap. Or that old gap. But for now, I'm stuck in the middle with you. Look at our fairest price to do business. Whap, 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 whap. Same place as 2 days ago. So the last 2 days was nothing but the market coiling up, pulling that rubber band back tighter and tighter and tighter for whichever way it's going to break. Well, Charles, is there even a possibility the market goes nowhere with this FOMC? Yeah, that's what it did last time. And we were all thoroughly disappointed. So any scenario is possible, but the highest probability is once Powell starts speaking, this market will make a very big move. Skewball says, I'm a little surprised they didn't clear the stops at the high. Well, they didn't build them up there for nothing. Ebb and Flow, thank you for the compliment. Appreciate you. Skewball says, what if it happens 2 times in a row, meaning an FOMC meeting that goes nowhere? That, for me, would mean a lot of people trade options before the FOMC. Yeah, I mean, that could explain it, but I would still say the FOMC has the potential to break the market one way or another every time. I've just seen it so many times. Kay says, are all orders seen on Bookmap or are there hidden orders? Well, there is a way they hide orders, which is what's called an iceberg. So essentially, they got to put, any orders that are in the books are going to show up here in the liquidity. But what they'll do is they'll just put one contract, right? And then what happens is when the market gets up there, they will use sophisticated software to add another contract and another contract and another contract in like a fraction of a second so that you can't see ahead of time, much like an iceberg, the way like an iceberg, most of it is underwater and you only see a little bit above, but there's still tons below. They'll keep adding more size and more size and more size and more size as the market pushes into it. That's as close to hiding an order as they can. And then, of course, there's always stop orders, right? There's orders that aren't in the books yet, but when the market gets there, they enter the books. So we can't know about stop orders, but we know once they fill. And we can't know how big an iceberg is going to be, but the Bookmap software will show us when an iceberg is happening. For example, right there. There's an iceberg at the low right now at 86. They filled 55 contracts, but they have more to fill. We don't know how much more. Boom, 87 contracts, but they have more to fill. We don't know how much more. And now there's 5 of them. There's 5 different people putting icebergs there. They only got 87 contracts. Do they want more? Okay, so now they made an iceberg at the high. Only filled one contract so far, but they want more. Ooh, took that one out. Somebody tried to get 200 contracts, but that's all they needed. So now we're coming back for that other iceberg. You got these 5 computers fighting against this one computer. Scooball says that's why it was pretty always, and it was a great strategy. But with options now, it's not. I disagree. I think just because it happened last time doesn't mean that's the new normal. Remember, all Powell has to do is say one thing, one word that people weren't expecting, and instantly everything changes. So the possibility of a major move remains. Okay. So they just canceled that iceberg. So they're no longer looking to add here. Something changed. Kay says, is there a way to see real-time open interest? That's an options thing. I don't mess with those. I just focus on the futures. And the interest is the number of orders in the order book. Essentially, you can think about it like if you look up here, you see the different color profile. So the brighter the color, yellow to orange, the more liquidity. The darker the color, blue to black, the less liquidity. So where is there interest to do business on the futures? Well, there's some here, and there's some here, and there's a little less here. And so I just watch what happens. What happens when we go up to this one? Do we fill? Do we reverse? Do we keep going? That's information. Same thing if we come back down for this one. All day, every day, baby. Oh, yeah. Kay, I mean the open interest in the ES futures market. Yeah, I don't look at that. Like I said, I just look at the liquidity. Where are the orders in the books in this moment right now? Where do they go when the market gets there? When price gets to those orders? Do they spoof? Do they disappear? Or do they let it fill? If they let it fill, what comes next? Do new buyers step in? Do new sellers step in? I can't know ahead of time, but I wait and see when it does. What are you looking for is the liquidity that changes in real time. So if you see this little white line that runs up and down here, that's a very crooked line. You can see the actual line there. Okay. So what's on the right side of the line That's what's in the order books right now. Okay. As time passes, we see where the price is going. This is the bid and the ask of the price. So what I look for is when the bid and the ask reaches that level, what happens to the liquidity? So for example, when I look up here, I'd have to zoom right in to see. Let me zoom right in there. Okay, so what did they do with the liquidity right here when price came up to it? They disappeared it. See how it's dark red, lighter, 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 and then right there it's gone. Seconds before the market fills it, it disappears. So that was a spoof. That wasn't real. Now, am I zooming in that much in real time to actually see? No, no, no. I'm just using that to explain it to you. But bigger picture, my eyeballs are just trained to recognize where is the liquidity and what happens when we get there. Do they fill? Does it disappear? And I can look back and I can see how that liquidity changed as market moves changed. Right? So as the market was coming up, there was no liquidity up here. But then when they reversed and started heading back down, somebody put liquidity up here. See? So what those people are trying to do, they're trying to create a magnet that's going to pull price up to those levels. So, okay, let's say the price starts to move up there. Well, then what happens? Does it start to disappear? Does it get darker and darker? Or is it still there when price gets to it? That's information. Andrew, do we know exactly what time Powell is supposed to speak? Yeah, 2:30. So this is generally the point where it starts to slow down. I know we haven't gone anywhere, but this is generally where the tempo will start to slow a little bit. The range will get smaller and smaller. Everything will kind of calm down. And then we'll have about 10 minutes of just chill. And then at 2:30, Papa Powell walks out and it hits the fan once again. And of course, I'll play the video of him speaking here on the channel. Okay, would it seem that most of the liquidity is up at 95? Would the market most likely go to that point from here after he speaks? How do I answer that question? So there's what a market will normally do, and then there's FOMC. So yes, normally if the most liquidity is up here, the market's sooner or later going to head up to there. But again, I need you to understand, once he starts speaking, anything can happen. Okay? They have got professional body language experts that are looking at every nuance of how he moves his hands, how he blinks his eyes. They're analyzing every single word he says. And anything can change in a fraction of a second. You know, someone can ask him a question and his response to the question freaks somebody at Goldman Sachs out and they start selling, and then the algorithms recognize the change and they start selling, and in a fraction of a second, everything changes. So please don't be locked into the idea that just because there's more liquidity above, that's where we have to go. Nothing matters. It's a gamble. It's like rolling the dice, baby. Anything is possible. But on a normal day, yeah, that would be where we'd assume the market is going. Oh, Andrew, thank you, brother. Appreciate you. Scooball says he was a minute late once and the market started to sell off. Yep. I mean, anything, you got to understand, man. There's people all over the world with their butt clenched real tight right now. Their job depends on whatever he says. And so there's a lot of tension in the air. They can do anything. Skeletor says Powell, for the most part, is always sounds dovish. Oh, believe me, they know. They know Powell's every, personality trait and habit, and they know what to expect. But anyway, all of that is not for us to worry about. All we worry about is where does price go. And so far, it's going nowhere. Where are you going? Nowhere. Well, we got 6 minutes till Papa Powell comes out. Any questions for me till then? Chris V, have I entered anything yet? No. I wouldn't even know where to begin. Right? We are dead in the middle of that balance area. Right? And we are dead in the middle of today's range at the POC. So never in the history of the world has there been more of a 50-50 chance from here. And that would be a gamble. So I need a little more insight. Generally, what I try to do when the FOMC happens is if it feels like it's going to continue to move in a direction. So let's say he starts talking and it starts grinding higher and it just keeps going. I'll just pucker my butt cheeks, get into a long trade. As soon as it goes a little bit higher, I just stick a stop right above my entry and I just see how far it can go. And most of the time it'll come back and stop me out for a tick of profit. But every now and then I get lucky and I get a massive move out of it. And so that's the fun of the gamble. And I'm willing to accept the risk. But if I was to try to get in that trade right now, I wouldn't know which way to go, long or short, because there's just no information to guide. Jono, favorite movie? You've probably never heard of it, but it's called The Fountain by Darren Aronofsky. Skeletor, have you had good days on the FOMC in terms of profit? Yeah. And I've had bad ones too. So like there was a while where I stopped trading them, or I stopped trading them with a real account and I started just trading them with a paper account because I had taken so much pain on the times where it didn't work. But then I just kind of learned how to do it. I had to change the way I was thinking about markets. And like I just told you what I do. When I feel whatever it is that gives me that feeling, when I feel like I know what's happening, I just get in the trade, get a stop above my entry or below if it's short, and then wait and see what I get for it. That's the best system I've ever come up with. Ronald says balance will break to the upside. If you put a gun to my head right now, that would be my guess, but I wouldn't be confident enough to get long. Now, once we repair the poor high, I could, but for now, not sure. 3 minutes to Papa Powell. Skeletor buy on the dip? No, quite the opposite, right? So buying a dip would be as the market's moving lower, you think they're going to find support and turn around and head higher. What I'm describing is literally the opposite of that. It's a momentum play. It's like it's already gone down and it should turn around, but it just keeps going, right? Then it's like, oh shit, this is momentum. Let me get short and then get that stop below my entry as soon as possible. There's no way to buy the dip because you don't know where it's going to reverse. So you're trying to trade momentum, not reversion to the mean. Anyway, let's just see what happens. We're 1 minute away. I'll talk about it if I see something. All right, here we go. So I'm going to go quiet. If there's anything that's worth discussing, I'll turn my mic back on. Otherwise, enjoy the show, folks. It's about to go down. Not price, but the show.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment.
Can they get above that poor high?
The labor market remains
and what
very
happens
tight.
when they do?
Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves,
this is one of those moments where I could go long.
Does this whole collection of data, do we assess it as suggesting that we need to raise rates further?
As soon as
and
the
if we make
market's
that
above my
conclusion,
entry,
then we will go ahead and raise rates. So that's how we're thinking about the next meeting. And,
I will say it's
how
not
we're thinking
looking
about
good
meetings going
because of how
forward
thin the
potentially.
volume
But we're now mainly
for
thinking
now
about
they
the
have
next
the
meeting.
momentum.
I will also say, since we're talking about
it, see what happens.
between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates.
Okay, so we just made it to the balance area high. This is a very important deal or no deal level. If we turn around and come right back down into value from here, it is bearish moving forward. If they can push back above there and keep it going, it is very bullish moving forward. So let's see what happens. This is an important level. Uh-oh, they're back above.
Doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but doing performing well this summer. Is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So,
Okay, so that was a back test of the balance area high and another push that is bullish to see. Can they stay above 46.05?
That was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increase.
Okay, so the fact that they couldn't hold that breakout of balance increases the odds they will need to come back down and backfill these low volume nodes down here. But of course, anything is possible. It's a gamble either way. I stand corrected. They held it.
That we need to do more, that we need to tighten further. And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think, core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Michael McKee.
At this point, you say the policy.
Frito says yesterday's singles at 93 told the tale right up to the high of the day. But they're doing it again, right? They went up there yesterday. They went up there 2 days, or on the 19th. Then they came back up and they reversed in exactly that place. What were they doing? Creating liquidity up there, creating stops. They came up for it and they barely got anything. So I'm looking for support to head back up there and test it again. We got these low volume nodes at 98. Often all the market needs to do is backfill those, and that brings in the buyers for the next move. Again, all of this is a guess. Papa Powell says one thing, everything changes, but that's what I'm feeling. They're trying to break out of bounds. They just don't have the buyers yet. Not yet.
Particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation repeatedly has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this sluice will say.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy?
Okay, so there's the backfill of the low volume node. So that magnet is now gone. If the market wants to head back up and break out of this balance area today, they should find support up here right now, pretty much between 98 and 93. Okay, that's where the buyers should step in. If they do not, if we start to pull back down below the halfback, it changes everything, because then it becomes a look above and fail of the balance area. So at this moment, as long as the support holds, I am bullish. But as soon as it breaks, completely the opposite, I become bearish. Okay? So can the buyers hold it? Let's find out. Uh-oh, left some single prints. That's another magnet. Dun, dun, dun.
Sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates?
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Steve.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress.
Dust. Dun, 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 dun. All right. So, I mean, this is literally, this to the tick is the last potential support they have. If we break below 92, it is officially a look above and fail of a balance area, which is bearish to see. So all the weight is on the base of those single prints. Can they hold it? Nope, they cannot. All right, that's bearish, folks. We're now talking about a bigger picture understanding of the market. This is a balance area. Generally, the way the market works, it goes from one end of balance to the other and then back again. They tried to break out and could not do it. So that increases the odds, not necessarily today, but over the next few days, we're heading back down towards that balance area low. So this is officially untradeable as far as I'm concerned. Too much uncertainty. But I'll be paying close attention come tomorrow for that. One thing that is catching my eye right now is the amount of icebergs that remain here on the book map. That tells me the market might try to come up and get some of that liquidity. But the look above and fail makes it too uncertain to take any trades in that direction. Okay. Well, shit, maybe we're heading straight to the opposite end of balance. What did Powell say? He pissed somebody off.
Been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong, aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching, the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is a restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel, or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle-class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long, or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event, the market had assigned a roughly 99% probability to the rate move that you announced today. The decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. the implication is, we will do what it takes to get inflation down. And in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask,
PSC. Thank you, sir. Appreciate you. Good trade, too. Congrats, brother. So now what are we watching from this moment? Well, probably the market's going to go nowhere, but the momentum is clearly now to the downside. So we're watching that week reference at 45.76. Can we poke down there and repair that? If so, is that enough to reverse and come back up, or do we get new sellers? Let's see what happens.
Really, the active tool of monetary policy is rates, but you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute?
Okay, so there's the repair of the first week reference. They still have the momentum. So now we're looking for resistance as we push back up. Do we get sellers stepping in once again? If we get sellers, we look to repair the next week reference. If not, we look to rotate back up to the POC. So can the sellers remain in control? We're looking for resistance. Hard to know an exact level, but somewhere around the 45.80 area.
Thank you.
Thanks very much.
Thank you.
All right, take it back. If the FOMC is over, so is the volatility. So that's it, folks. That's all, folks. What just a beautiful show. Guys, come on, give it up. That was so much fun. For a second there, I thought Scooball was going to be right. It was going to be boring, and they did not bore. So my thesis remains the same, okay? For those of you that are newer to the channel, let me just walk it back a little bit so you understand bigger picture what I believe is happening with the market so that you can then understand, shorter term what I'm seeing right now. Okay, so this move to the upside, I see that as a giant move of excess. Okay, that means it's momentum. The buyers are in charge. They're pushing it as far as they can push it. Now, when we made the lower low on this day here, we knew that momentum to the upside had come to an end, or it was at least the highest probability. From there, we don't know how the market will balance off that momentum. There's two options. One, it can just go sideways at higher prices. Two, it can pull back down with price, looking for buyers at a lower level, for example, at a gap fill. So then, when the market turned around and made the higher high right here, we knew they were balancing with time. So at that moment, we have a balance area. We know where we ran out of momentum to the upside. We know where we ran out of momentum to the downside. So we don't do any more asking what could be happening. We just observe. The highest probability, once you dip below the balance area low, if you pull back in, is that you're heading to the opposite end of balance. That is, of course, what we did yesterday. Then we looked above that balance area high and we pulled back in. So that increased the odds that we were heading lower. Now, once FOMC happened today, anything was possible, right? Because it's a new piece of information that the market is reacting to. Could have got us really bullish. So we don't really know. But what the market just did, it got that new information. Though that FOMC notes came out, Papa Powell came out and did what he was going to say. And what did the market do? It tested that balance area high once again, and it failed. Dun, 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 dun. So in the immediate future, let's say over the next few days, that increases the odds we're heading back down to that balance area low. Okay? So I imagine it's actually probably going to happen in the overnight tonight, but that is likely the next place we're going. The fact that we had this big move of excess, we spent these couple of days balancing it off. If this becomes resistance, if we poke below that balance area low, and it's not an exact level, but we'll just call it 45.60. If it pokes below there and we start to get new sellers, that will increase the odds that we cannot balance off the excess with time, and instead we must balance off the excess with price. So at that point, we start to look to head back and balance off some of these weak references. Okay? If that is the case, and again, I'm just projecting for days forward in time, if we do get below 60, we do get new sellers. In my mind, the highest probability is that the market needs to head back down and fill the gap at 44.78. Now, there is completely possible we just poke below there and then come right back up, right? So I got to see those sellers there to be convinced. But to me, the fact that we got new information and it still wasn't enough to take the market higher means we got to put the market on sale and look for those discount shoppers. They won't pay full price. They want to see it go 50% off, 75% off before they step in. Fighter Pilot, thank you, sir. Appreciate you. So with that, there's not much else to do today. We're right smack dab in the middle of that balance area. So probably we just kind of grind around until the close. But like I said, in the overnight tonight or in tomorrow's trade, I suspect we're heading for that balance area low. And we'll just have to wait and see. FRM says, what's the balance area on the NQ? Let's take a look. We'll take a look. It's in a chart called Market Profile. Ugh, you know what it is? It's that fucking node. That's what it is. Yeah. Dude, this node is just the strongest magnet ever right here. So you've got essentially two potential balance areas. You've got one that's like right here. This could be your balance area. Or you've got kind of a larger one that could be this right here is your balance area. But what is the NQ doing that is different than the ES? The ES tested its balance area high and failed. The NQ is testing its balance area low. So it is not bearish like the ES, not yet. That could be all it needed to turn around and head back up for the balance area high. So what I would be looking for now to get bearish on the NQ, I'd just say today's low. So if tomorrow they push below today's low and they get new sellers, I get bearish for that pullback. But as of now, it could go either way. They may turn around and head back up tomorrow. Charles, how the heck can you be bearish on one market and bullish on the other? They're separate. They're doing their own thing. So you can see, we came down, sent it back up. That same thing could happen right here. Now, if they do push below today's low and get resistance, my target would be that next gap fill down to like 15,270. But right now, could go either way. Dude, great day for the markets. All right, well, with that, I will say goodbye. I will say farewell. I will say au revoir. And I look forward to seeing you all. If you're in the brigade, I'll see you tomorrow morning. If not, I'll see you when I see you. Thank you kindly. Have a good one.